Good morning, and here it is, my Dunkin' Donuts coffee. You know me, I have one every day. That's actually probably the third cup I've had so far this morning. And so welcome, I am Kenny Polcari, your host of the party, and today is Thursday, January 20th, 2022. And what is it that you need to know? What's happening? Well, I'd like to say, holy smokes, Batman! NASDAQ is now in official correction territory, right? Getting slammed once again. Stocks continue to come under pressure as confusion reigns about the coming Fed policy. Oil up again on strong demand and on geopolitical pressure in Russia and in the Mideast. 10-year treasuries now kissing 1.9%. Only going higher, and they need to get this over with. The FOMC meeting starts next Tuesday and Wednesday, so all eyes and ears are paying close attention. And what are we having for dinner tonight? We're going to have the linguine tricolore, but we'll get to that in a moment. So smash, bang, crack, kaboom, pow. You remember that, right? Batman and Robin, late 1960s. Do you remember those fight scenes? And the characters, right? The Joker, now played by Joey Biden, because now he's getting really funny. The Penguin, played by Jimmy Bullitt. The Riddler is hands down Jay Powell. Mr. Freeze is Joey Manchin. Do I need to even explain that? The Mad Hatter is easily played by Nancy Pelosi, while Egghead is Chucky Schumer, as he attempts to change the rules of the Senate to force a win by the Dems. And Catwoman? I think that's Kirsten Sinema. We can go on and talk about that all we want. I just thought it was appropriate, right, to kind of go through the characters. Stocks yesterday got banged around again. The Dow off 340 more points, or 1%. The S&P down 45 points, 1%. The NASDAQ losing another 166 points, or 1.15%, putting it further into correction territory, now down 11.6% from the November highs. The Russell losing 35 points, or 1.6%, leaving that index just 4% away from official bear market territory, while the transports gave up 70 points, or 0.5%. 10-year treasury yields ended the day at 1.86%, a stunning 40% increase since the beginning of December, and you're going to need it to kiss 2%, which is just 7%, a 7% rise from here before it really comes down. And why? Because stocks will continue to get beaten up, and my sense is that between here and 2%, we could see the bottom fall out, right? So we're going to get hit with that big round number 2, and it should cause investors in a range of asset classes to take a second look, catch their breath, recognize that the Fed is not going to suddenly change its mind, and it is committed to fighting this transitory inflation that they assured us was nothing to worry about. But clearly it is. I mean, look, yesterday, Joey gave Jay the Powell to do what he must to fight inflation, saying in his 2-hour speech that it is the Fed's job to fight inflation, which to me means he's not going to try and pressure the Fed to remain accommodative and allow the Fed, and he will allow the Fed to take rates higher. In fact, I think he opened the door and almost encouraged him to take rates higher, right? Because he needs to stop this rampant inflation. Otherwise, it's going to come to bite him and everyone else in the backside. But if you've been paying attention to what we've been talking about, none of this should be a surprise at all. Stocks were overvalued. We talked about that. They've been overvalued. They will remain overvalued until we get more clarity from the Fed. Look, remember what I've been telling you. This is nothing more than a math problem. If you change the inputs, then the answer must change. So when inflation was 1.6% and interest rates were 0 and 10-year treasuries are 1.4, then valuations on a range of assets, stocks, startups, real estate, cryptos, NFTs, all surge. We saw it. We lived it. But when inflation is 7%, on its way to probably 10%, and rates go from 0 to 1% on their way to 2+%, and 10-year yields go up 40% in 4 weeks with no end in sight, then valuations have to reprice lower. Why is any of it confusing? It's 6th grade math. Okay, look. Yeah, the recent volatility is all about the recent pace of inflation, which is getting worse by the month. It's about the lack of clarity from the Fed about the pace and increment of any rate rise. And I say this because the Fed was very clear about the direction and pace of any change in policy for most of 2021. They controlled the narrative. They were keeping everyone at bay. But then suddenly, the macro data was clear. The macro data was not what they thought it was. And they suddenly started eliminating words and thoughts from the monthly statements. And then they pushed out Jimmy Bullard, who was not a voting member of the FOMC committee, come out to be the mouthpiece. He's the one who floated the balloons, telling us in late November that the Fed needed to be more aggressive. They needed to end the taper sooner, and they needed to reduce the balance sheet and do it all together at the same time. That is when the tone changed. And by the way, so many people are asking, what exactly does roll off the $9 trillion balance sheet mean to investors? What does it mean to Joe Q public? Why should they care is the question. Well, they're going to find out what they should care as we continue to watch as we move through the landscape. That is when they started to lose control of the narrative. Suddenly, all the other Fed members started to sing the same song. All you have to do is look at the charts. They scream, we are behind the eight ball and losing control of the conversation, leaving now some of the biggest investment banks in the country to drive that conversation, which is confusing because there's an inherent conflict of interest there. They enlisted their friends at Goldman right in the new year to drop the first bomb, and then JP Morgan to drop more bombs, and others, as you see on a daily basis, now calling for 6, 7, and 8 increases. Then we get the start of earnings season and forward guidance. The banks are the first ones out the door. And while many of them are beating on the bottom line, it is that nuanced guidance and commentary that has caused some investors to run for the door. The XLF, which is financials ETF, is down 6% in 1 week. JP Morgan's off 12%. Goldman's down 15%. Citibank down 6%. Bank of America down 8%. Suddenly it's a mess. Everyone is talking about 4 to 8 rate hikes in 1 year with increments of 25 basis points to 75 basis points. And then you want to know why stocks are taking it on the chin? Now look, I still think we're going to get 3 increases totaling 1% this year. Not sure what 2023 looks like, but all I know is you can expect more for sure. But this year, I think we're getting 3 hikes totaling 1%. Now, this doesn't mean that you all panic and run for the door, right? What have I been telling you for months now? You need to have a conversation with your advisor. You need to reweight your portfolio to be more defensive. You need to not chase so many of those sexy high growth valuation names right now. You want to own them? Be patient. Let them come to you. And you need to consider more value names and when you're adding new money to your portfolio, right? In fact, the value trade, the SPYV, is only off less than 1% year to date, while the growth trade, the SPYG, is down 8.5%. Energy and financials, which are names I've been suggesting, are outperforming. The XLE is up 15% year to date. The XLF is still up 0.5% even after the recent pullback, right, which was 6%. So it was up 6.5%. A pullback that I see as an opportunity. Industrials are down 1.1%, but that pales in comparison to the worst performers. The XLK down 8.2%. ARC down 22%. Disruptive technology, right? Consumer discretionary down 7.5%. Healthcare down 6.5%. Real estate down 8.5%. Basic materials down 3.5%, right? Those aren't the value plays. Oil continues to push up and is now trading at $86.79 a barrel on its way to $90 as demand around the world surges. All while Joey told us yesterday that he's doing all he can to find available sources of energy to help stop the surge. Oh boy, you don't want to make me go there right now, do you? Anyway, add in the geopolitical unrest in Europe and the Mideast, and you have a recipe for higher prices, right? And this, as the U.S. and the Northern Hemisphere is going from winter to spring and spring to summer. Eco data today includes initial jobless claims, 225, continuing claims expected of 1.56 million, Philly Business Survey of 19, and existing home sales, which are expected to be down by 0.5%. My guess is we could see a bigger drop. 30-year mortgage rates on conventional loans are now trading at 3.7%. That's up from 3% just weeks ago and only going higher. So expect housing to hit a brick wall and begin to pull back as well. Again, it's a math problem. Interest rates go up, prices have to come down to balance out affordability. A $500,000 mortgage at 3% is $2,108 a month. The same mortgage at 3.7% is $2,300 a month, which is a 10% increase in the cost of carrying that home. At 4.5%, the cost goes up by 20% to $2,500 a month. See? So prices are going to have to adjust. And the earnings story, that's going to continue to steal the spotlight, along with the complete dissection and fact-checking of Joey's speech yesterday, but that's another story, and I don't want to digress. U.S. futures this morning are up. The Dow's up 118, the S&P's up 21, the Nasdaq's up 120, and the Russell's ahead by 7. This should not surprise you at all after the recent beating that these stocks have taken. But don't go all in. Don't think this is the bottom. Don't think, I got to get in. Keep your head on. Pick your spots, pick high-quality stocks that can perform and outperform in what is sure to continue to be a volatile environment. Next week is the Fed meeting, like I said, so get ready. The market's pricing in an announcement of 4 hikes in 2022, each one 25 basis points. So any change in that thinking are going to cause investors and algos and traders to react. I think and hope that the first move will be 50 basis points, only because that might shake the branches a bit more, causing the weaker investors to fall out, and then maybe we get that flush that we so badly need. European markets this morning are mixed, right? Inflation across the UK is now at a 30-year high. We know that. All eyes are on earnings and on what the central banks are doing both here and across Europe. German bonds, like I said yesterday, are now yielding just over 0%, which is a huge positive considering how long they've been negative. At 7 o'clock this morning, European markets were all trading around the flat line between, down 0.2% to up 0.4%. Last night, the S&P closed at 45.32. Now, it pierced its intermediate-term trend line at 45.76, and it fell below that. The S&P is now in this 44.25, 46.75 trading range. It should find some short-term support right here around 4,500, which are the lows of December. So how much now is going to depend on what we hear next week, the tone of what we hear, and the urgency of what we hear. So sit tight, because that's going to be key. The urgency in his voice, right? Has it changed? Is he more anxious than he was even last month? Remember, you can always text the word INVEST to 21,000 on your cell phone to get my digital business card. Feel free to download it, send me off an email, text, give me a call. I'm always happy to talk and engage about markets, planning, thoughts, concerns, ideas, any of that stuff. Anyway, okay, so what do we have for dinner tonight? So we're going to have this great classic pasta dish, linguine tricolore, right? So that means linguine of 3 colors, really. And it is, it's a simple but yet classic dish. And so here's how you make it. For this, you're going to need small cherry tomatoes, you need capers, you need sliced olives, Parmigiano cheese, you need breadcrumbs, and you need extra virgin olive oil. You want to slice the cherry tomatoes in half. You want to put them in kind of a roasting pan, right? Either a cookie sheet or a flat pan. You want to spread them out. You want to season them with salt and pepper. You want to pour some olive oil on there. You want to add the capers. You want to take the sliced black olives. You want to put them in there. You want to put them all down, lay them out. You want to cover it with Parmigiano cheese and breadcrumbs. You want to put it in your oven at 400 degrees for 15 or 20 minutes max. While that's happening, you want to bring a pot of salted water to a rolling boil. You want to add the linguine. You want to cook it until it's al dente, 8 to 10 minutes. You want to strain it, always saving a mug full of water. You want to take the tomatoes out of the oven, and you want to pour that whole mixture over the hot linguine, oil and all, breadcrumbs, cheese, everything. So delicious. You want to toss it. It might look a little bit dry to you, which is why you have the water from the pasta. Add a little bit at a time just to keep it moist. Again, you don't want it wet and soupy, but you want it kind of moist, right? Serve it immediately in warm bowls, and always have fresh grated cheese on the table for your guests. And, for this, you know me, I would drink a white wine with this dish. It's not heavy, so you need something light. I would choose my favorite, Pinot Grigio Santa Margherita, but you take what you want. In any event, look, today is Thursday. The day is young, just getting started. Tomorrow's the end of the week, so until then, take good care.